All right, we are going to hit on the first objection we left off with in the last video around the idea of infinite banking and whole life insurance, really building awareness for the consumer if you're interested in a policy. Cash value. This is always the question, the number one objection that I hear, that I receive when people reach out to say, hey, how do I maximize the cash value? Because why I am interested in this idea of the infinite banking concept is because I can pay money into a policy and use the money. I want to have access to the cash value. Maybe I don't even want to use it because I don't need it, but I want to see it there. It does not make sense for me to pay $1 into a policy and see zero there. Doesn't make sense to see me lose 50%, 70%. Like, what's the maximum value I can receive? Especially when I start to do more research and see and hear that the big players, big banks, corporations, wealthy individuals do this. So, two main things to touch on here when it comes to maximizing your cash value. And I'm going to be consistent as ever with this because I always touch on this. The proof is in the pudding. We've got all of the data behind it. Company selection and then policy design. Companies that we have seen consistently deliver the strongest cash values to consumers, not illustrations, if you're looking at a life insurance illustration, but actual performance. And the banks that we work with look at these companies first and foremost. MassMutual, Guardian, New York Life, and Northwestern Mutual. In no particular order, if I'm looking to optimize my cash value, we've seen those companies consistently deliver, and we have proof of performance from them as well. That's the first thing. The second thing is policy design. So what a lot of people are not aware of is when you open up a whole life insurance policy, you can actually choose where your money's going. You'll find that it can go toward the premium, which I'll refer to often as the initial insurance expense, or directly toward this PUA, which stands for paid up additions, this PUA rider. I'll refer to this as a cash dump in. You'll see exactly why. Premium dollars I pay into a policy. In the first year, I typically see next to nothing show up in cash value. With some products, it's the first and second year. So if I have a $10,000 base premium, I'm not going to see that in cash value in the first year. So if my goal, going back to the last video, is to practice infinite banking, premium dollars, nothing shows up in cash value. The reason why, if we want to understand that further, is really the life insurance company is really overcharging me upfront for the cost of insurance, the death benefit. There's costs associated with the product forever, but the heavy expenses are really upfront with base premium dollars with traditional whole life insurance products. Now I'll add before we move on to the good part, is that premium dollars, once I surpass the first year, or first and second, depending on the company and product, premium dollars do build cash value. So you will see it generate equity that you will have access to over time as well. There's some advantages to base premium dollars as well. But my point is, right off the bat, I see nothing, so I'm behind the 8 ball. I've got to make up for lost time. Whereas PUA dollars, if I pay the same $10,000 down here, I see it in cash value in the first year. The majority of it, there will typically be a small fee with most products and most companies, but the point is, from a high-level overview, you'll see the majority of this payment show up in cash value. That's money you can access, begins earning the guaranteed rate, dividends sooner, begins compounding, and really is the key to maximizing the cash value on a policy. When we set policies up for corporations and individuals, they all want to know how to maximize this. And it's exactly what they do, or exactly what we do. Now you see a small dollar sign over here because PUA dollars do purchase us some death benefit, but really everyone we work with is interested in the cash value here. So the question that I've heard many times, and if I don't hear it, often I'll ask for the individual because I appreciate when people do that for me with something I don't really understand is, can I put nothing into the premium and everything into the PUA rider? My dad asked me that the first time I showed him this years ago. And the answer is no. So my follow-up question would then be, well, how low can you go? Because if premium dollars do not build cash value immediately and give me less short-term and long-term, which is proven with actual data, but if this gives me less money, what's the minimum I can have? And that's a legitimate question. We're going to show you the answer here, or give an answer. Depends on the limits. We have an insurance company limits, insurance company's limitations, and then also the IRS limitations. The insurance company limits have to do with the premium and PUA component. What you'll find with the top companies is typically you can go as low as a 10% premium. Call it this 10/90 split. Now, it's not exactly a 10/90 split with all of them. Some let you go a little bit lower. And what I'll add on top of it is some smaller carriers let you go even lower. Some smaller companies like a Lafayette Life or a Security Mutual, we've been able to drive the base premium down to 5%. One case, I got it down to 3%. So some smaller carriers have limits that are a bit more aggressive, which for our awareness, it's good to hear about that. However, I do like these guys because I've seen them consistently deliver. It's my personal preference, but we work with all carriers. We don't work with them because they're exclusive to agents, just to be transparent there. But 10/90 split, what this means is if I have a $10,000 base premium, that means I could pay, call it another $90,000 per year into PUAs for a total of $100,000. So the insurance company will allow me to 10x my base premium in respect to a total payment. And again, each company has different limits. To be very specific, we can always let you know those limits are. Email us, call us, we'll let you know. So first thing is the insurance company limitations. The second is the IRS. So why so many people are attracted to cash value life insurance is that it is a safe area to position money, regardless of what happens in the economy, stock market, whatever. We can expect these policies typically to produce between 3 to 5%. That's the net internal rate of return. So safe area to position money, no matter what happens, it keeps going up. Number two, it's liquid. I can access the money anytime. We're going to look at that in the next video when it comes to policy loans. But then three, and this has to do with the IRS limit, tax-free, if I stay within those IRS boundaries. So any life insurance policy can become classified as this MEC, which represents Modified Endowment Contract. If it does, the cash value grows tax deferred, but anything I access, I must pay ordinary income tax on the gains. And in addition to that, I have to deal with a potential 10% penalty tax on the gains if I'm under the age of 59 and a half. I don't want that. No one wants that. It ruins it if cash value is my goal. The death benefit with a MEC is still paid out income tax free. So there is an appeal there depending on my objective. Now the fun part to this, I know I sound like a nerd when I say that, is every policy has what is called a MEC limit. And what many are not aware of is that the policyholder and the agent can actually set that MEC limit wherever they want. You'll find that it has a direct relationship to an individual's age, gender, I didn't write that down, but it's age, gender, and total death benefit. So if I have a case like this, where I have that $10,000 base premium, and I'm paying $90,000 per year into PUAs, for a total of $100,000 per year, what I would do, that maximizes the insurance company limit, minimum premium, minimum expense, maximum cash value. Then I set the MEC limit at $100,000. Now I have the ability to go up to $100K per year, reap the benefits of a high cash value policy, and still have the IRS classify it as life insurance and reap the tax benefits. If I trigger that MEC, if I go over that MEC limit, now I've got to deal with income tax on the gains when I pull it out, all of that stuff. Now with that said, it's very easy to prevent a MEC. Even if I do it by accident, we can easily reverse it as long as we do so typically within 30 to 60 days. It's almost never a non-issue. But let's look at some examples, shall we? So we're going to look at two quick examples here. I love this spreadsheet and seeing the numbers. We pull all of these directly from illustrations with companies. This was a case that someone actually experienced. So going back to the first video, the idea of infinite banking, he was interested in infinite banking. He didn't do it the first time he was proposed an example because he was looking at paying $100,000 per year in, and he was shown something like this 40-60 split. So he's paying $100,000 in, and what 40-60 means is 40% is directed toward the base premium, 60% toward PUAs. So a total of 100, 40,000 toward the base. In the first year, he's got just about $64,000 in cash value. That's his net value. Continues to make this $100,000 payment just for 4 years, and then he drops off to the $40,000 payment per year. What is highlighted in yellow represents his break-even point. So as we look at this guy, what do we notice here? Tallies up his total payments. First 4 years is easy. 100K times 4 years is 400K, then 40 a year. He was looking at front loading it and then paying just the premium. Positive between years 5 and 6. He didn't do it. And the main reason why, he's involved in real estate, business, and he said, you know what? I get the idea that the money's always compounding, but I can't do this. Like there's other things I can do with my money, like a 40K hit. Like I can use that for a real estate transaction, which will produce me greater results. And that was his preference. We got to listen to the individual that we're working with. So years later, he sees this. He looked at that when he was 40, actually. This when he was about 45, a little bit younger, but exact same thing in terms of his out-of-pocket. These two are the same company. So same individual, same health rating, same company, same product, same funding, different design. So going to the topic of policy design, this is with one of the major mutuals as well. So the 100 for 4 years. Look at this. Positive between years 4 and 5, meaning he's got more than what he's paid in. Exact same company. The reason why is that his premium is only $10,000. So again, premium, PUA, premium dollars do not show up in cash value. The 40K, year 1, I had 60%. Here, $10,000 base premium, and I'm very, very close to 90% in this example. Now, some companies you'll still see between 80 and 85% if they've got a higher upfront PUA fee. But my point, you'll always see richer cash values up front. Here's really what to look for, because there's a lot of companies with different rules. 80 to 90% right off the bat is a good indicator to know, okay, is it set up with a low premium? Because this can be difficult to read. This is a simplified version. Imagine looking at the full illustrations, which we do go through those in detail. I would check out our reading a detailed life insurance illustration video where we go through line by line. But as time passes, cash value continues to build. Here's the difference, meaning how much more he has in cash value with this option compared to this option. What do we see? Has more all the way through. He pays into it for 30 years, up until age 75. Had more from start to finish. And he's not looking at this as an investment or anything, because life insurance is not classified as an investment. Really, he's saying, hey, here's money that I usually park in cash, but now I can park it here. I actually see it grow. The death benefit's fantastic. But really, with the cash value, when I want to access this as a line of credit for other opportunities, I can do that. And it's a nice alternative to funds I had in cash, that 3 to 5% net return. So that's one example of front loading it. And then a second example, we won't go through this in full detail. I'll just point out the main items here. $50,000 per year, same age, 30-70 split, so 30% going toward the premium, $15K, 35 toward PUAs, and look at that. Shows up in cash value. Compared to the same company, same product, individual, all that stuff, $5,000 base premium, 10%. You've got just about all of it in cash value. There's a term insurance rider there as well, which adds a little bit of cost while we don't see 95%. My point though, it's got almost $8,500 more in this option with the same company compared to this one. Breaking even, more money in cash than what he's paid in by year 5 compared to this guy, year 8. You've got the cash value difference column, and this is the same out of pocket all the way through, the 50K per year. And what happens? More money all the way through. And that's consistent. Like when you look at, again, corporations, big banks, wealthy individuals, they only do this type of design, and their advisors know what to look for as well. The individuals I work with, at least, when I've encountered those advisors that ask the right questions, they know what to ask. If it's not set up like that, you're out of the door. Like you're not going to get anywhere with them. Because again, going back to the actual data. But going back to the main objections of policy design, or I should say cash value, I'm interested in the concept. How do I maximize the cash value? That's it. company selection, and policy design. Hope you enjoyed this one. This is one of my favorite topics to talk about. I had such an urge to go such deeper and really dig into the technical aspects of those policies, but we've got other content that we do that. If you have any questions, please reach out anytime. We'd love to connect with you. Hit the like button, subscribe for more. That does help us if you liked it, and I hope this helps. We'll talk to you soon. Hey guys, Steve Parisi here. If you enjoyed the content you just saw, please subscribe, like, and hit the notification bell for future videos. If you'd like more information or to see some custom policies for yourself, feel free to call or email our offices at the contact information below.